about the good things that come with a low interest rate environment, but let's talk about some of the bad things that are happening. Perhaps if you're in retirement years and you're relying on investments that you might have in term deposits, those interest rates also are low and make it very difficult for a return. Enlarge a little, Gavin, on the bad side of this low interest rate environment.
Yeah, so anyone who is relying on their fixed interest type investments to live on, and so these are generally the retirees who, most people in retirement have some form of term deposit as their cash reserve. They might have superannuation and they might be getting an age pension, but generally most people would have a little buffer there of term deposits, and that's going to earn a lot less now. So they're potentially going to need to use a bit more of their capital to live on to maintain their standard of living. And what that can, if interest rates stay at these record low levels for an extended period, which is what the expectation is at the moment. That can change very quickly depending on the global economy, but the expectation is that interest rates are going to be at these very low rates for a longer period.
Okay, is that something that if you are approaching retirement or you're in retirement, you might need to factor into the way that your spending comes about in the times to come? Is that spending an issue?
Yeah, so there's two sides of the equation. The issue is being caused for those retirees. The issue is being caused by the income side of the equation. So their income's going to go down because they're earning less interest on their investments. But there's two ways to deal with that. One is that you can try and get a higher rate of interest than you get with fixed interest. And so you can do things like take more risk rather than just investing in a big four bank and have it guaranteed. You can take more risk and invest in some corporate debt. So it's a high risk and potentially a high level of return. It's still loaning them money. Or you can go to the other side of the equation where you can actually go and buy riskier assets. So you could potentially own part of a bank rather than loaning money to the bank. It's more risk, but it's potentially more return as well. So it's a balancing act. The issue is caused by income, but you could actually try and increase your income by taking a different sort of risk. But the other side that you mentioned, Neil, was you can also reduce your expenditure in line with that. So if you're not keen to take any more risks, you just want to keep your money in the bank but want the same level of income, you're going to eat into your capital. Another way to do it is to try and reduce your income to be in line with what reduce your expenditure in line with your reduced income.